All right, welcome to The Explainer. Listen, there's a huge shift happening right now under the surface of the markets. You see stocks hitting these absolutely crazy new highs, right? But the smart money, they're doing something else entirely. They're making a very quiet, very calculated pivot. And today, we're going to break down exactly what that move is, why they're making it, and, you won't believe this, how it all ties into a geopolitical storm that's brewing on the horizon.
Okay, let's just start with one number, 7,126. Just think about that for a second. That's the S&P 500 blowing past another record high. I mean, after years of just incredible growth, the market has climbed to a place where even the most bullish pros are kind of taking a step back, looking around, and asking themselves, what now?
And that right there, that's the heart of what we're talking about today. At these levels, the whole risk-to-reward equation, it's completely flipped on its head. The potential gains you might get from stocks are now staring down some pretty significant downside risk. So with everything priced to perfection, you've got to ask, is the juice really worth the squeeze anymore? What looks like the most sophisticated players out there, they've already made up their minds.
So, this creates what we're calling the 7,000-point dilemma. It's that feeling, right? When the market's this high, every single decision feels huge. You've got that classic battle going on in your head, the fear of missing out on more gains versus the fear of getting caught in a nasty correction.
Okay, and here comes the brutal truth. We see this happen over and over again. About 90% of retail investors, they completely ignore bonds. They don't even think about them until after the stock market crashes. But by then, it's way too late. The party's over. The central banks have already ridden to the rescue, they've slashed interest rates, and that move just demolishes bond yields. The window of opportunity to lock in those juicy, safe returns, it doesn't just close, it slams shut.
So think about what's really happening here. When you buy stocks at these record highs, you're paying a massive premium. You're paying for all this amazing future growth. But here's the catch. All the economic data, the stuff that really matters, is starting to scream that growth is slowing down. It's like paying for a front-row concert ticket just as the band is announcing their last song.
But you know what? While everyone is glued to the stock market soap opera, something amazing has been happening completely under the radar. A massive opportunity has opened up in a totally different part of the financial world. We're talking about safety, predictability, and, for the first time in more than 10 years, a really, really attractive return.
And when you put them side by side, the difference is just, wow. You've got stocks over here, right? Valuations are expensive, returns are a total guessing game, and the risk is high. Then you look over here at high-quality bonds. They're fairly valued. The return, it's literally guaranteed if you just hold it. And the risk, especially with government bonds, it's about as low as you can get. The difference is just night and day.
And look, this isn't some abstract idea. These are real numbers you can get right now. You can find solid corporate debt in euros paying over 5%. The 10-year U.S. Treasury, the bedrock of the entire global financial system, is sitting around 4.3%. High-quality corporate bonds also hovering just over 5%. I have to say it again. For the first time in a very, very long time, you can get paid and paid well to be safe.
So the big question is, how do you actually grab this opportunity? Well, the pros use a really clever, time-tested strategy. It's called a bond ladder. And let me be clear, this has nothing to do with timing the market. It's all about building a smart, resilient structure for your money. The idea itself is just brilliantly simple. Instead of dumping all your cash into one bond that pays you back on one specific day, you split it up. You create a ladder. So let's say you have 50,000 euros. You'd put 10,000 into a one-year bond, 10,000 into a two-year, another 10K into a three-year, and so on. Each of those is a rung on your ladder. What this does is it spreads out your risk from interest rates changing over time. And this is where the genius of the ladder really shines. It takes the single biggest risk in bond investing, what happens if interest rates move, and turns it into an opportunity. Think about it. If rates go up, awesome. That shortest bond on your ladder matures, and you can immediately reinvest that money at the new higher rate. And what if rates go down? That's great too, because you've already locked in these fantastic high yields on all your longer bonds for years to come. It's a true win-win.
Now, I need to be super clear about this. This is not trying to time the market. No one is trying to call the absolute top in stocks. The pros don't think like that. They see this as just smart rebalancing. It's about taking some chips off the table, skimming, say 10 or 15% of your profits from stocks, which are obviously expensive, and moving that money over to build a solid foundation in bonds, which are fairly priced.
Okay, if you really want to understand just how powerful this strategy can be, we need to peel back another layer. We've got to get into two key concepts that the pros are absolutely obsessed with.
duration, and credit spreads. And trust me, once you get these, you will never look at bonds the same way again.
All right, first up, duration. So what is it? It's basically the secret sauce that can give you big capital gains in a portfolio that most people think is, well, boring. Just think of it like a seesaw. On one side, you have interest rates, and on the other, you have the bond's price. When rates go down by 1%, the bond's price goes up by a certain amount. Duration is the number that tells you how much it goes up. Higher duration means a much bigger move.
And this is where it gets really interesting. A 10-year Treasury, for example, has a duration of around 8.7. That's way higher than a 2-year bond. So what does that mean? It means if the Fed or the ECB finally pivots and cuts rates by just 1%, the price of that 10-year bond could shoot up by 8.7%. That's the part everyone forgets. Bonds aren't just about the yield. You can get serious price gains too. It's all about total return.
Okay, next concept. Credit spreads. Super simple. It's just the extra bit of yield, the extra payment you get for taking on a little more risk. It's the difference between what a company pays you to borrow their money versus what the super safe government pays. You can think of it as the market's fear gauge. When spreads are wide, it means investors are scared. When they're narrow, like they are now, it means everyone's feeling pretty complacent.
And check this out. Right now, that spread is razor thin. We're talking historically tight at just 0.81%. What that's telling us is that investors are maybe a little too comfortable. They're not demanding much extra pay for taking on extra corporate risk. And that, right there, is a huge reason why a lot of pros are saying, you know what, I'll just stick with the super safe government stuff for now.
So all of this whole strategy of shifting into bonds, it's not happening in a vacuum. It's playing out against this really complex, really volatile global backdrop. And analysts are starting to give it a name. They're calling it the war pivot.
So what on earth is a war pivot? Well, imagine you're a central banker. A war or a conflict somewhere breaks out and suddenly oil prices go through the roof, pushing inflation up. But at the exact same time, your own economy at home is starting to look weak. What do? Do you hike rates to fight that new inflation and risk crushing your economy into a recession? Or do you cut rates to try and save the economy, but then risk inflation just spiraling completely out of control? It's a nightmare scenario. There are literally no good choices.
And listen, this isn't just some theory. We're seeing things happen right now, like the blockade of the Strait of Hormuz. That's a critical choke point for a huge chunk of the world's oil. That kind of event creates massive uncertainty. It's exactly the kind of shock that could force a central bank's hand, making them cut rates to support a fragile economy, even if inflation is still high. And if you've been paying attention, you know what that means. That's the exact scenario where, because of duration, longer-term bonds could see their prices soar.
Okay, so let's tie this all together. Let's talk about the end game here. What is the ultimate goal of this entire strategy? It's all about one thing: preparing your dry powder. It's about being proactive and getting your capital ready for when the next big opportunity finally shows up.
See, that 5% yield you're getting from your bond ladder, that's not just some boring income stream. No. Think of it as your war chest. It's your dry powder factory. It's capital that is actively growing, actively compounding, just waiting for the right moment to be redeployed. And that moment is when stocks aren't at all-time highs anymore. It's for when things look scary and assets are on sale.
And this is the massive difference between just holding cash and what we're talking about here. Cash sitting in a bank, it's a melting ice cube. Inflation is eating away at its value every single day. That's a passive, reactive position. But capital in a bond ladder that's earning a real return, a return above inflation, that is a proactive, strategic weapon. It's money that is working for you even while you're waiting.
So, I'll just leave you with this one question. Think about it for your own portfolio. Market cycles, they're going to happen. A downturn is not a question of if, it's a question of when. And when that day comes, what is your capital going to be doing? Is it going to be sitting on the sidelines, losing its buying power to inflation every single day? Or will it be on the field, earning a solid 5%, getting stronger, and ready to pounce on the next great opportunity? Honestly, the decision you make on that, right now, could really define how you do for the next 10 years.